Hello. All right, so we're going to jump into chapter 11 here. Chapter 11 is going to talk about the three major types of business organization: proprietorships or sole proprietorships, partnerships, and corporations. If any of you have taken Accounting 111 bookkeeping, then you had some experience with sole proprietorships and partnerships. So a sole proprietorship, the word sole means one. So there's one owner who is responsible for making the business, profit distribution, taking on all the responsibilities for running the business. There is no legal ownership agreement for a sole proprietorship. You just start your stuff. Now, the second is a partnership. Now, a partnership is made up of two or more people and they share ownership. Typically, a partnership is managed or overseen by a partnership agreement. Now, the partnership agreement is going to include everything possible for the partners. In other words, who's putting up what to start? How is the responsibilities of running the business distributed? How are the profits distributed? Whose responsibility if there's a problem? Um, how do you handle if one partner wants to leave? All those things are included in the partnership agreement. It pretty much should handle any question that comes up between the two owners. The third type is a corporation. Now, the corporation is very different from the sole proprietorship or the partnership in that a corporation is a separate entity from the owners. The owners are stockholders. All states require an application for a corporation to be formed, and the state tells the corporation how many shares of stock they can sell. The state will also look at the Articles of Incorporation, which is essentially the rule book. As far as sole proprietorships and partnerships, there's very little regulation other than standard business rules. However, for corporations, it is heavily, heavily regulated by, for example, the EPA, the SEC. Ownership interests in corporations are normally evidenced by stock certificates, and we're going to talk about that later on. If trading is among individuals, the company is a closely held corporation. And that's what you're going to find typically in small companies where the family owns the business. So the family owns all the stock. Now, with a corporation comes something called double taxation. Double taxation occurs because of the fact that the corporation gets taxed on its earnings, and then the stockholders get taxed on the distributions of those earnings, which are called dividends. Many states have enacted laws permitting the formation of LLCs. I'm sure you've heard of them. LLC is a limited liability company. It has some of the features of a corporation, in other words, some of the protections of the corporation, but the revenue rather goes directly to the owners. Unlike partnerships or proprietorships, which terminate with the departure of their owners, a corporation's life continues on when a shareholder dies or sells his or her stock. So to sell my ownership in a corporation, it simply means I sell the stock. If I want to sell my ice cream store down on the boulevard, I have to find somebody who wants to buy it. That's a lot more difficult. Because of continuity of existence, many corporations formed in the 1800s, believe it, 1800s, are still around today. The transferability of corporate ownership is easy. That's what we were talking about, selling your stock. That's it. Transferring the ownership of proprietorships and partnerships, a lot more challenging. To sell an ownership in a proprietorship or a partnership, you have to find someone to purchase the business. Now, remember, with a partnership, the partnership agreement will state how ownership can change hands. Partnerships and proprietorships are usually managed by their owners, right? If it's a sole proprietorship, there's only one owner. That person makes all the decisions. With a corporation, however, we have three tiers. At the top of the tiers are the stockholders, or the owners of the corporation. Reporting to the owners is the board of directors. The board of directors oversees the company's operations, sets strategic plans, and makes sure that the company is running the way it's supposed to. Reporting to the board of directors are the professional executives, the CEO, the CFO, the CIO, and all the other C-suite people. They report to the board of directors. To see a good example, or an interesting and entertaining example of the way the board of directors and the stockholders interchange and communicate, the movie Wall Street has a great scene. So, corporate advantages. The corporation is a separate legal entity, and by being a separate legal entity, there's limited liability for the stockholders. The liability for the stockholders is essentially whatever they paid for their stock. The corporation has a continuous life. It just goes on. The owners can change through the sale of stock, but the corporation itself just keeps going. The management structure of a corporation is pretty sophisticated, meaning that it has a lot of people who have experience, knowledge, and education in running a business. The corporation has easily transferable ownership rights, as we saw with the stock. And of course, corporations can sell stock or sell bonds to raise capital. For sole proprietorships or partnerships to raise capital, they have to go begging to a bank. The two big disadvantages to a corporation: number one, governmental regulation, and there's a lot of it. The second is that double taxation that we talked about before. So here are the financial statements for a sole proprietorship. The big things you want to look at here are, here's investment by owner. This is the capital statement. Remember, with a corporation, it's called a statement of changes in stockholders' equity. Here's withdrawal. With a corporation, a withdrawal is a dividend. In a sole proprietorship or a partnership, it's a withdrawal. So we have an ending capital balance, and that goes on the balance sheet under equity as owner's name, capital. Now, with a partnership, it's very similar. So we total up the capital balance here, but then we split the capital balance under equity on the balance sheet between the partners. So we move to some things about corporations. Now, corporations are required in many states to have what's called a par value, which is essentially an arbitrary number that the corporation puts on a share of stock. It represents what's called the legal capital, the minimum amount of assets that must be retained in the corporation. If you look at typical public companies, you'll find that the par value is a very, very small number. It could be a percentage of a percentage of a percent. There's also in some states no par stock, and no par stock may have a stated value. Stated value works similarly to par value. States approve the maximum number of shares of stock corporations, and that's called the authorized stock or authorized shares. Authorized stock gets sold to the public, and it's called issued. Then, and we'll talk about this more a little later on, sometimes corporations buy their stock back from the stockholders. In that case, the stock that's repurchased is called treasury stock. And finally, we have the outstanding stock. Those are the shares of stock that are in the hands of stockholders. Common stock is pretty basic. That's what we're typically talking about when we look at stock for a corporation. All corporations issue common stocks. That's the way they get funds, they get capital. And the common stockholders have some rights. Number one, the right to obviously buy and sell stock. Number two, the right to share in the distribution of profits. Number three, if the corporation goes bankrupt and the assets of the corporation are sold, these common stockholders have a right to some of the cash from the liquidation of those assets. Number four, the right to vote on significant matters that affect the corporate charter, which again is essentially the administrative Bible for a corporation. And finally, and maybe most importantly, common stockholders get to participate in the election of the board of directors. Now, preferred stock is a little different than common, hence the name preferred. It comes with some special privileges. Common preferred stock has a preference. It comes before common as to the sale of assets in the case of a bankruptcy. It also has preference to dividends. Preferred stock gets paid first, and preferred stock comes with a guaranteed percent dividend, a guaranteed return, if you will. Most preferred stock has cumulative dividends. That means that if I don't get my dividends for 22, in 23, if dividends are declared, my 22 dividends get paid first. Cumulative dividends that have not been paid are called in arrears, and that's what I was just describing to you. So here we got some examples. Dillon Incorporated has the following stock outstanding. They have preferred stock, 4%, $10 par, 10,000 shares outstanding, and common stock, $10 par, 20,000 shares outstanding. So let's be clear about what we're looking at. We have preferred stock. It has a guaranteed dividend of 4%. It's $10 par, and there are 10,000 outstanding shares. So if we multiply 10,000 times 10, that's, 100,000. 4% of 100,000 says that we have a $4,000 dividend to pay out every year for our preferred stock. The common stock is at $10 par, 20,000 shares outstanding. So assuming that the preferred stock dividend has not been paid for 2 years, in other words, we have 2 years in arrears, if Dillon pays $22,000 in dividends, how much will each class of stock receive? Well, the first thing we need to know is the preferred stock cumulative or non-cumulative? Because in non-cumulative, if I don't get my dividend in 22, it's gone. So let's look at both cases. On top is the cumulative example. So we had 2 years in arrears. Each year is a $4,000 dividend. So 2 times 4 is 8. So that's the dividends in arrears. Then we have this year's dividend for $4,000. So we have a total of $12,000 due to the preferred stockholders, which leaves $10,000 for the common stockholders. Now on the other side, on the non-cumulative side, we had 2 years in arrears, but that's life. Under non-cumulative rules, you don't get that money. So the only thing that's due the preferred stockholders this year is $4,000, which leaves $18,000 for the common shareholders. So you can see why common shareholders obviously would prefer a non-cumulative preferred stock. However, preferred stockholders are going to want cumulative because they're limited to that. These guys in this case are limited to a $4,000 return. The common shareholders could get nothing, or they could get far more than 4%. All depends on what's left. So we're going to issue par value stock here. Nelson Incorporated is authorized to issue 250 shares of common stock. Year 1, Nelson issued 100 shares of $10 par common stock for $22 a share. So be clear here, we're authorized to issue 250 shares, but we're actually only issuing or selling 100 shares. So since we sold 100 shares at 22, we debit cash for $2,200. Now our legal capital is going to be calculated by taking the par value of $10 times the number of shares that were sold. It's 100 shares, so 100 times $10 gives us $1,000. That gets credited to an account called common stock $10 par value. The difference between the common stock $10 par value and what we actually got paid goes to an account called paid in capital in excess of par value common. So notice that we're very detailed in our account titles here because we're going to have several issues of stock. So that takes care of that sale. And on the statement of cash flows, this is a financing activity. Selling stock is considered financing. Next, assume Nelson is authorized to issue 300 shares of a third class of stock, 7% cumulative preferred stock with a stated value of $10 a share. Nelson issued 100 shares at a price of $22 a share. So again, we're authorized to sell 300, but we're selling 100 shares. The price is $22. Now, we see that 7% cumulative statement. That tells us preferred stock is what we're dealing with. So 100 times 22 is $2,200. That's the debit to cash for the sale. We're going to credit preferred stock, $10 stated value, 7% cumulative for the $1,000 of 100 shares times the stated value, which is the same as par, of $10. The difference of $1,200 gets credited to, paid in capital in excess of stated value, preferred. So here's our financial statement. This is the balance sheet. Here's the stockholders' equity section. Quite a bit different from the ones we looked at in Chapter 2, isn't it? So you'll notice we have our preferred stock on top, and then we have each of our common shares listed as they were sold or issued. So there's the common stock $10 par. Here's Class B $20 par, and no par, common stock no par. After the stock listing comes the paid in capital in excess. So we have stated value preferred, we have excess of par common, and then we had the Class B common. Total paid in capital is $10,350. Retained earnings we're told is $5,000, and we have total stockholders' equity $15,350. So as we continue to advance the balance sheet, it's becoming much more informative. We've got lots more to work with here. All right, that's going to be it for the first half. I will see you in part 2.